Hello, hello, hello. Welcome back to the Daily Stack, your daily show on all things markets, macro, Bitcoin, AI, everything you find important that is shaping the world in the 21st century. We are covering it. Lots of things to cover today. We got market manipulation. We got South Africa cracking down hard on Bitcoin. Tether being frozen, $344 million worth. So many things are happening. And this is all, meanwhile, we are experiencing the largest energy destruction of supply the world has ever seen. Infra, please, what is going on?
A lot is going on. I think we're going to start with the manipulation that we saw this morning. Is that
Yes, please. Let's chat this up because your tweet is making the rounds. What happened?
Yeah, I wake up early here on the West Coast, and we got some news out from one of the news aggregators that I can't remember the exact headline, that talks were going well and de-escalation was right around the corner and everything's going to be just great when it comes to what's going on in the Middle East. And we promptly got a huge move in the S&P 500 futures and a huge move in oil. So we can see that we pumped about 0.5%, which is a pretty large move for something as large as the S&P 500. We moved pretty significantly. The news came out here at 5:42, and if you look 5 minutes before that, there was this huge spike in volume. About 950 contracts traded in, I think, 3 or 4 seconds. So you can see two big volume candles there, and then these other two far above the average. You can see the average during that time period was much lower. We can switch to the 30-second, and you can see that it was far above the normal average for volume, about 10x the average volume there. And then we got the news, and obviously we got a huge pump. What exactly was going on there, I'm not too sure, but it was highly sketchy. I mean, you had this was not like a TWAP sort of approach to trying to get into this trade. They just hit the ask on a huge, for pre-market at least, 950 contracts to trade in 30 seconds. That's or actually it was more than 950. It was a full 1,750 contracts in a 30-second period. That was far above the average, and you can see it even move the moving average. It was so large. They just hit the ask and cleared the order book, and we got this huge pump. ES moved about 0.1% just in this 30-second period of time. That's how much they kind of just hit the ask and market buy, smash buy, no regard for the price that it was executed at. And then the news came out here 5 minutes later, and obviously we got a huge pump. So there's a lot of this kind of thing going on right now. It's like, I'm sure everyone's timeline is filled with it. Every day we're getting more of this kind of thing, and it's unfortunate, but yeah, it's just kind of, I don't know, I guess late stage capitalism, late stage fiat, whatever you want to call it. It's just kind of sign of the times, I guess.
Okay, so yeah, the tweet is Iran U.S. talks in Pakistan may see breakthrough in preparations tonight or tomorrow. Iranian diplomatic source says per RIA. So RIA is a Russian outlet, correct?
State media owned. Yeah.
State media. Yeah.
State owned media company. Yeah.
And yeah, so it seems we've seen this on our side a lot, right? I mean, we have lots of inconspicuous trades going on right before headlines of further negotiations, pieces coming, and then you see the market ramp up.
We also got this too last night. I'm not sure if most people caught this because it was after normal market hours, but we got this crazy. So I've kind of curated a list of OSINT, or open source intelligence. People they take data from Telegram groups and Wall Street Journal, right, mainstream media. They take all this data and they put out they kind of aggregate it almost. And I've kind of curated a pretty good list. And there was one of the bigger accounts posted unconfirmed reports of explosions in Tehran. And we got a crazy move almost a full percentage point in S&P 500 futures. We got a crazy move. This is the 1 minute chart. So I think it happened over like 15 minutes, that move. I'll go back. I hate when TradingView does that. But yeah, it was an absolutely massive move in not only the S&P 500, but oil. Oil got a huge move as well. Then it turned out it was just air raid or air defense drills of some kind. And so we reversed. And there was a report floating around one of those larger OSINT accounts that I saw this morning that he was making accusations that some of the smaller, kind of maybe less reputable OSINT accounts are selling the ability to move markets, and like, it's not a good thing. And oil was moving around like crazy yesterday as well on this news. Obviously, WTI I think hit 100 and promptly reversed. Yeah, here. So pretty wild stuff going on these days. Every headline can kind of whip around, some very, very large assets. I mean, the S&P 500, $65 trillion asset. And, it's getting moved around like a meme coin.
Yeah, by tweets from Walter Bloomberg, right?
Yeah.
Just like some French dude, like who copy paste Bloomberg headlines, and it's able to move this much. I mean, do you think that this is a real problem that we have here? That Twitter accounts are selling the ability to post a headline and move markets like this?
I obviously have no, I don't want to make any accusations, but yeah, I mean, when there's so much money to be had, just my guess, not accusing anyone of anything, especially Walter Bloomberg, don't want anyone suing me, but my guess would be that given how much money there is, the incentive structure that we always talk about with Bitcoin in Bitcoin land, right? The incentive structure is such that if you are a large OSINT or data aggregator, you're incentivized with potentially a lot of money. I mean, going back to just the S&P 500, just that move that we saw earlier this morning, I did the math, quick dirty math. And it would have gotten you about, back here, this move would have made over $1 million, I think $1.5 million, right? And so you kick back, I mean, I'm not saying this is what happened, but theoretically, you could kick back, I don't know, a couple $100,000 to a guy running a Twitter account, And we're seeing it not just with like traditional markets, but we're also seeing it with prediction markets too. Obviously, it's a really big problem, and I think that the credibility of markets is very important, especially for the U.S. Right? This is something you might see in emerging markets, but it's not something you're supposed to see in the global reserve currency issuer in our markets. We're supposed to have the most free, legitimate capital markets in the world. And, we have a lot of issues. I mean, there was a guy yesterday or a couple days ago that put a Kalshi bet or maybe Polymarket for the temperature at a given airport. And he bet on like 100-to-1 odd of a particular. Then he went out with a hairdryer on the airport run around the tarmac, right, with a hairdryer and pointed it at the temperature sensor.
Yes.
Like we're just like, I don't know. People throw around that term late stage capitalism or late stage fiat. And like I used to balk at late stage capital when people say that, like, oh, it's kind of dumb, it's kind of reductive. But like, I don't know. Over the past couple years, I've kind of come around to that as a potential way to describe it. Like, is all of this kind of stuff just inevitable? When you hyper financialize an economy to the degree that we have, when wealth inequality is so bad, when everyone is just kind of scheming how to get theirs, when the cost of living is soaring and inflation is, eating away at wage, you have a bunch of Zoomers that, now they're it's bad enough when they were trading meme coins or altcoins or that kind of stuff, penny stocks. Now they're doing polymarket, and there's like professional polymarket traders and Kalshi traders where literally I've come across them. That's what they do. It's just such a weird gambling, speculative kind of thing. Yeah.
Yeah, and it seems as if we've been given the green light from above, right? That the biggest players, whether it's the president and his family or those in his orbit, it seems as if these things are just given a pass now. And if you're not partaking in these games, then you are just you're a sucker who's being
Yeah.
left behind, right? There's no more really morals left in the game of money these days, and you can see it in charts like that. Like, what is going on there?
It's just, and this is the 1 minute chart. I mean,
Yeah.
I was sitting at my desk. I'm normally not at my desk after the market closes, but I was sitting here, and all of a sudden, I was watching the S&P 500 futures, and all of a sudden they just start going vertical the other way. And I was like, what's going on? What's going on? So I go to my OSINT Twitter list, and I see, unconfirmed reports of explosions. Oh, here we go. There's and it was all just circular reporting. It was like one Telegram chat that was being cited by another Telegram chat, which was then being cited by this kind of small account on Twitter, which was then amplified. Like, it just snowballed and turned into kind of a crazy thing. So, yeah, it's just wild days we're living in.
Yeah, and going back to what you were saying about the sanctity of our markets and America with the reserve currency, it's important that people take these things seriously. But then you see the disconnect between the cost of oil on the markets and then what it costs to actually deliver a barrel, right? And you could say that Besant is working overtime with his boys over on Wall Street to make sure that that paper number does not go up too fast. And in doing so, I mean, what kind of back scratches do you have to give in order for people to play along and risk this kind of money when this is serious business, right? What is going on with oil right now?
Yeah, so we are currently living through the worst energy crisis in history, according to the International Energy Agency. That's not, me saying that or some random commodity expert. That is the International Energy Agency, and we have a historic amount of supply being disrupted right now when it comes to oil, and the problem being that you can't print oil, and so and not only that, but oil is a very inelastic commodity, meaning the price has to go up really a lot to get you to stop using it. And people can, normal people watching this can apply it, that price elasticity of demand. You can think of that as, what price of oil or gasoline would it require for you to stop going to work, right? To stop going to, help your mom through her cancer treatment, to stop going on vacation. Usually it's going to require very high price. And from the research I've read, it's about 0.1. It's as low as 0.06. What that means for every 1%, if the PED is 0.1, negative 0.1, what that means is that for every 1% increase in the price of oil, demand for oil only goes down by 0.1%. So this is how and why you have commodity experts calling for $200 oil. By the way, we've already gotten it. It's not theory. The landed barrel of oil in Sri Lanka went for $270 per barrel. And I think it was Malaysia, maybe Philippines, one of those other kind of emerging markets in Southeast Asia. They had a landed cost of 240, 250 something. So it's already happening. We already have $200 oil. We already have $250 oil. Physical oil, Omani physical oil, or maybe it was Dubai. It's so much has happened. That was already going for above 150. So a lot of this is kind of already, it's not theory. We're trying to buffer it with various different kind of offsets. We have inventories, global inventories or storage, whether that be a refinery, an export terminal, or the government. The Strategic Petroleum Reserve is kind of a very large inventory. We're drawing these down. So Here is the SPR. This was during Biden's the strategic midterm reserve, as the guys on Bloomberg were calling it. We drew down from 640 million, call it, all the way down to about 340, so 300 million barrels that they drew down ahead of the midterms. Now, this was the last time we got an energy shock, right? And the one we have now is 7, 8, 9 times worse. The problem is that Trump got into office around here and only rebuilt it from about 391 million to about 414. So 15 million, something like that. That's the problem, is we have a finite amount of this buffer, and inventories, there are charts floating around commodity Twitter, and you can see inventories are just going straight down. And once those are gone, they're gone. And I think that, we are still in kind of the early days of, especially if this continues, still in the early days. 2022, just to kind of make it equivalent or put it in context, 2022, we had 1 to 1.5 million barrels per day disrupted from Russia, Ukraine. This time around, we're talking about 13 million barrels per day. So there's really a huge, that's what, 7, 8, maybe 9 times worse than 2022. And, we know what the Biden administration did. They, higher oil is not good for anyone. They did the same thing that we are doing, which is they draw down on your strategic stockpile. The problem is, once that's gone, it's gone. And we only have, if you look at the IEA release schedule for these reserves, we don't have much longer. We got like another month and a half, 2 months, maybe at most, before we're scratching the bottom of the barrel. Now, some countries are better positioned than others, but broadly, that offset is going to be gone if this continues for another couple months.
Yeah, this chart shows the difference between
the countries in their strategic petroleum reserves. China looks like they've been preparing for something like this.
Oh, yeah. Yeah, and they've also been electrifying too. There's been a huge electrification push within China as well. So, a lot of people trying to claim that this is, 4D chess to screw over China, but they've not only built a huge stockpile, but they've also been electrifying as well. So, how effective it'll be, if that's really the goal, I'm not sure.
And I mean, a country like India, right, with well over 1 billion people, with only 21, right? I mean, like, what are 21 million barrels of reserves?
South Korea, yeah.
Yeah. And I mean, these are industrial nations, right? They need this energy to keep their GDP going.
You cannot print oil. It's really important for people like oil. People talk about supply and demand. But it's really important to remember that when we talk about demand for oil, what we're really talking about is consumption of oil.
Mhm.
Well, okay, let's deconstruct that even further. If demand for oil is how much oil is being consumed, the other way of saying that oil is everything in the modern economy, consumption equals economic activity. Right, whether it be the power to generate, the electricity to power a factory to make a thing, the gasoline that needs to go in the worker's car to get to the factory, the fuel to get it on the airplane or the ship over to America, and then to transport it all around, right, to the distribution center. All of it is economic activity. So when we talk about supply and demand for oil, how they must balance out, what we're really talking about is the need to destroy 13 million barrels per day of economic activity, and that is roughly equivalent, especially if this escalates or goes on for another month or two. We're going to be talking about a disruption close to 20 million barrels per day, which was what 2020 looked like during the lockdowns. That's what it looks like when you destroy 20 million barrels per day of oil consumption. It's, here in LA, I always point out, like, Sunset Boulevard was empty. It was a ghost town. I was driving around like just for fun, because you never get to see it without traffic and crazy amount of people. I was just driving around like some of the Hollywood Boulevard and downtown. It was a ghost town. That is what the world must look like in order to destroy that much oil consumption or demand for oil. And so unfortunately, we cannot print oil. The physical world is kind of colliding. And yeah, different countries are going to be hurt in different ways and at different rates. I would argue here in America, we're not going to be seeing, shortages like Sri Lanka or Malaysia or Philippines. They're going to feel it in a different way. But we have arguably, just as severe feed through with U.S. Treasury yields and the stock market. We know in 2022, when the price again, on a fundamental basis, that shock was call it 1/8, 1/9 as bad, right? This one here with Russia and Ukraine. Two things happened. We got 2 quarters of negative GDP off of this. And again, this time is 7, 8, 9 times worse. We also got a bear market in the stock market. And if you look at foreign holdings of securities, right now they own about $69 trillion of US stocks, US corporate bonds, mortgage backs, US treasuries. During 2022, foreign holdings of US Treasury bonds declined just between Europe and Asia by $650 billion. And so, some of that was a mark to market thing, but, a lot of it was selling because these countries are short oil. Whether you're in developed Asia, or in Europe, you don't produce enough oil or gasoline or diesel or anything, right? You have to import it. And so you are short this commodity that is ripping higher in price. And, what do you do when you get pushed into a, large deficit, current account deficit? You have to fund it somehow. Either people are piling in, buying your debt, buying your financial assets via capital and financial account, or you're selling out of your foreign exchange reserves. And we know, again, they sold about at least a couple $100 billion, right? I don't think all of it was TLT, which was down about 40%. It's called at least $250, $300 billion of US treasuries got sold just by Europe and Asia for an energy shock that was 1/7, 1/8, 1/9 as bad as today's. And equity holdings, stock holdings declined by $1.3 trillion. Now, again, some of that was mark to market, right? The stock market was going down, so the value of the holdings declined. But, at least 300, 400, $500 billion of US equity selling. Well, you get that kind of thing again, where countries are like, look, we need oil. We don't really need a US Treasury in our foreign exchange reserves. We're going to sell it. You get higher interest rates. Well, higher interest rates for a debt dependent country that runs a large twin deficit here in America, you just increase the cost of our overconsumption. So yeah, higher treasury yields, and of course that bleeds through to the banking system. We had bank failures, right, because of the rapid increase in rates. All sort of read through with the rates. You start getting, hundreds of billions of U.S. equity selling. Well, lower stock market means lower wealth effect or negative wealth effect. That was where the wealthy, which account for half of 2/3 of GDP, so about a third of GDP, that is the top 10% spending their money. That is a third of GDP. And they've been spending their money because the stock market has been going up. Well, what happens when the stock market stops going up and goes down? They pull back on their spending. We're already seeing luxury names getting hit, which is kind of, probably the best way to forecast how that upper 10% is doing. Those luxury names are not doing well, indicating, that the wealthy might be pulling back. That's a third of GDP right there. People talk about oh, we're going to make all this money, selling our oil. Yeah, 1% of our economy is oil. Like 60 something percent, depending on the month, is consumer spending. And what do you like? The math doesn't math there. Yeah, is 1% going to do really well? Yeah. But is 2/3 going to do very poorly? Not only does the negative wealth effect cause the top 10% to pull back, but we already know the median American is already really unhappy. You can look at, consumer sentiment, for example, and we're basically at like 2008 GFC sort of levels on consumer sentiment.
Yeah, and we haven't really felt the effects yet of the oil crunch. That's what's crazy.
Yeah, and I'll overlay the red. The red will be so these are NBER defined recessions, And you can see we're at the same level as the height of the GFC. And I was just getting into the labor force, just becoming an adult. As I think my interview, I need to do the math and figure it out because I always talk about it. I want to say it was like a week or two after Lehman Brothers had failed. It was kind of like when I was getting my first real big boy job. We are lower than that. I remember, you turned on, you open any newspaper, turn on any TV. It was, I mean, like to remembering that, maybe I'm getting old, but remembering that and thinking that we are at the same consumer sentiment as the depths of 2008 is just insane. It's just insane.
Yeah. No, I mean, back then, of course, it was plastered everywhere. You couldn't get away from it. But now it seems like both the average person and the markets are in la la land, right? They're not, the average consumer definitely feels the pain, but it's not, they don't understand where it's coming from. And it just seems as if we haven't even gotten close to feeling the real brunt of the effects of the last 2 months of this war that shut down 13 to 15 million barrels of oil a day. It's hard to understand.
Yeah, and look, eventually, I put out a post very early on when everyone else was worried about inflation and bond yields were going up and inflation and higher oil. I was like, this is so bullish for TLT because you get demand destruction, right? The entire point of the higher oil price is to destroy demand. We're going back to the PED. That's the entire point of the price of oil or any commodity going up, is so that demand comes down to meet the supply, right? And we can see that before going in to every recession, going back to the 1970s and 80s, was preceded by a huge run up in the price of oil. Here I'll do log; it might be easier to see. Right, 1980. Here's into 1990, into .com, into 08. A lot of people forget the commodity run up that we saw into 08, and that was to some degree contributed to the great financial crisis. And of course, 2022, we don't have a red box, but that is because Biden changed the definition of recession. We did get 2 quarters of negative GDP in a bear market in the stock market. Now, you can make the argument that the stock market today is more resilient because of the AI trade and the hyperscalers and the Mag 7 and all that. I would just say, their free cash flow, when they were just churning out free cash flow and funding the capex out of their free cash flow, yes, that is true. But that is no longer the case. That is no longer the case. They are now increasingly funding their capex with debt. And who is going to buy the debt when Europe and Asia are decimated from a higher oil price? Sorry, something just happened and I just made a lot of money. I was looking for that move on SPY and we got it. I don't know what caused it, but sorry about that. Okay. What was I saying? What was I talking about?
Just how before every single recession, there's a huge run up in oil
Huge run up
prices.
in oil to destroy demand. AI trade.
Yes.
So people can say, "Oh, we're more resilient than we were." That's great. That is true when the companies were free cash flow positive. I can try to find this chart and paste it on my trading view to show people, but they are no longer growing their free cash flow. They, in fact, the rate of change over the trailing 4 quarters of their free cash flow is starting to go negative. So what are they doing? They're issuing debt, which is fine, right? Google famously had a huge, I think it was like 100 billion debt offering, and it was very, very long duration debt. Here you can see the free cash flow over the trailing 4 quarters growing, quote unquote, at negative 32%. So, it was one thing to, make the argument, oh, we're more resilient because look at free cash flow. I mean, back here in, coming out of 2022, their free cash, some of these companies, they were just churning out free cash. And their net interest income, because of the higher rates, was so great that they were raking in the revenue because they had all this cash that they were able to invest in T-bills which were getting such, dramatically higher interest rate, they were really, really doing well. I mean, free cash flow was growing at the peak 60% over the past 4 quarters here. That would have been, I guess, 23 and a 24. Well, it's a totally different story when you have to fund the capex out of free cash, out of debt. It's one thing when you're funding it out of free cash flow and your cash flow is off the chart. That's one thing. It's a whole other thing when that starts to go negative, because what it means is the only way to build the data centers, which we know, that to meet the demand for compute over the next 2 years, I forget the exact number, but it's hundreds of billions of dollars have to be spent on building data centers to meet the demand with what is estimated to, if we kind of carry out through to meet the demand, it's going to require hundreds of billions. And where's that going to come from? If it's not coming from free cash flow, which is where it was coming from when this was the safety trade, Mag 7 was the safety trade for this reason. They had huge free cash flow. It's a whole other thing when they have to issue a bunch of debt in order to do it.
Yep.
Because who is going to buy the debt? Going back to the oil price, Europe and Asia, we talked about, are short oil. They are short oil, right? They don't produce enough oil for their needs. They have to import oil, and if they're importing oil, then that means that the cost is their current account is going to be very sensitive to the cost of that energy. And what are we looking at? We're looking at a doubling roughly of the energy cost for them. That is going to push them into a current account deficit where, again, maybe they used to be buying our debt, our U.S. treasuries, our corporate bonds, right? Like Google, Microsoft, Meta, issuing a bond to build a data center. They might have been a creditor, when oil was at 55, but when oil is 110 or 100, they are at the very least, they are less of a creditor, if not an outright debtor. Right. So they are decimated from a higher oil price. They cannot fund the capex that is required for the AI trade because it has to be debt fuel, because we just look at free cash flow rolling over. Not only that, but the GCC was a huge creditor to the rest of the world. They generally run huge surplus, like 15, 20, 25% of GDP. That is starting to roll over because they can't sell any of their oil because the Strait of Hormuz is closed.
Yep.
So by definition, they turned from a creditor to a debtor. And we're seeing news over the past couple of days. I flagged this at the beginning of the war. Hey, look, all these currencies are pegged to the dollar. Their dollar inflows, the steady stream of dollars is getting shut off. There's going to be issues with liquidity. There's going to be issues with the peg. You saw UAE ask for a swap line with the Fed, right? So UAE, the GCC, right, the Middle East, they turn from a creditor to, at the very least, much less of a creditor, if not an outright debtor. We have a $1.7 trillion fiscal deficit per year, a $1 trillion per year current account deficit that needs to get financed. Then you add on top all this hyperscaler capex, which they are talking about hundreds of billions of dollars of capex that is going to be required to meet the demand for compute. Like, who is going to buy all of this debt? Someone has to fund our current account, $1 trillion per year. Someone has to fund our fiscal deficit, $1.7 trillion per year, and then call it, I don't know, $500 billion for the AI trade of debt. Who's going to fund it? GCC, they were very large investors, or at least they made pledges, a verbal commitment to be an investor. Well, when you're churning out revenue like there's no tomorrow selling your oil, when times are good, sure, yeah, you'll throw $1 trillion at a data center here, or $500 billion at a data center here. Sure, right? Makes a ton of sense by definition. Right? Because the current account is the other side of the ledger, is the capital and financial account. So by definition, if you're running a large current account surplus, you are a creditor to it's just double entry accounting. It's an accounting reality. And that made a lot of sense. But again, Europe and Asia decimated from oil doubling, call it, maybe even more with nat gas. And then you have the GCC, who are no longer able to run huge current account surplus due to the Strait of Hormuz and the regional war and a lot of infrastructure, right? Maslow's hierarchy of needs. One of my followers pointed this out, and I think it's a great point. These GCC countries, the hierarchy of needs is going to start to come into play. What's more important to them? Throwing, $80 billion at a data center, or rebuilding their critical infrastructure, which is going to cost at least $55 billion to do.
Yeah, and it's not as if it's just the Strait of Hormuz that is being shut down right now. I found this tweet today that I'd like to discuss with you. Can make it a little bigger. Is there a coordinated takedown of the world's energy supply? The random hits on refineries and energy facilities worldwide are piling up at an insane rate. Something sinister is unfolding right before our eyes. So we've had some big ones in India, right? Multiple power plant boiler explosions on April 7th and 14th, followed by a major oil refinery on the 21st. Australia, the Geelong refinery erupted in a massive fire with explosions on April 15th. We've got it in Mexico, Romania, Texas, oil rig refinery related explosion rocked the heart of American energy on April 21st. This is this week, right? Of course, Iran's in the middle of the conflict. Kuwait, Qatar, the Ras Laffan LNG complex, right? I mean, the helium that's needed to build these chips and to do MRIs, this modern medical practices that we are so used to in this modern world are going to be rendered too expensive to do on a regular basis. I mean, if it's one thing if just the strait is shut down and there's this conflict between America and Iran, but the fact that, I don't even see Russia on this list, and there's still a war going on between Ukraine and Russia, and they're blowing each other's up their oil infrastructure. So
yeah, 500,000 barrel per day of capacity has been taken offline in Russia, right?
Yeah.
We've been focusing a lot on something really big must have happened, because we're making crazy moves right now, by the way. Oil's up. WTI is up at 99. Brent's up at 105. S&P 500 went from being positive-ish, flat, to now down half a point. So I'm not sure if something just broke, but yeah, I've been watching to this point. Everyone's focused on the Middle East, which is good, right? We should be, but there are equal concerns with what's going on with Russia. Every day it seems like there's a new report of a new attack on either an oil export terminal or a refinery or a petrochemical plant. Just really, really major stuff going on with Russia, who is, by the way, one of the largest with resources generally, but especially with energy and oil and kind of the petrochemical side. So not only are you getting the huge shock that we talked about with Strait of Hormuz and what we talked about with the Middle East, but then you're getting 500,000 barrels per day taken offline from Russia, and then you're also getting, as you mentioned in that post, there are, look, I don't know, I try not to be too tinfoil, and people get real touchy with some of their theories and that kind of thing. But it's really hard to not see that there's something coordinated going on. It was not, it was Texas, right? Here in America, we had a refinery that was about 300,000 barrel per day capacity that was taken offline. We had Australia. We had, there was a petrochemical plant just, I think it was India. That was what I was looking at earlier today. There's so much going on. I can't even remember everything. It's just like every day. And it's not the Middle East. It's Russia. It's Australia. It's India. It's, I want to say like Malaysia or something, where there was also a petrochemical plant issue. Texas. I don't know. I don't know who that would be. I don't know what their intention is. That's kind of not my area of expertise, but there's definitely something going on for sure.
Yeah, it's global at this point, and some people are saying that this just opens the door for the climate lockdowns, right? The energy lockdowns, the work from home, do not travel. Lufthansa canceled over 20,000 flights recently. This summer, in terms of vacations, is going to be pretty hairy. Check your flights before you go to the airport, because you don't know whether they will be canceled or not. It's weird times. It's very weird times, and yet we still feel as if everything is sort of as normal right now. But it feels like any Monday we could start the week, and it would be just a completely different story, and they're gonna announce something big.
Yeah, the climate lockdowns, like, I really don't want to believe that stuff, right? Agenda, was it 2030?
2030.
2030. Like all that kind of like, I hate the WEF and I try not to spend very much time on it because it gets me so like riled up, I really do, just like with a visceral hatred of all that kind of stuff. But like the Trump administration, are they part of that? Like what, you know, I thought they were fighting the kind of like globalist
Yeah,
thirds,
well,
allegedly.
they also
Yeah.
said no new wars, right? So I mean, it's hard.
Yeah. Yeah. Yeah.
And
Yeah.
they
I
were,
hope it's not, man. I hope it's not like a coordinated, intentional, Agenda 2030. I hope it's not that. But again, like I generally try not to be too conspiratorial, but it's really hard to look at a lot of this stuff and not go like, what is going on? Now, look, it could be that we're focused on it, right?
Mhm.
And all of a sudden our brains are just like hyper fixated on anything that involves oil. Maybe it's just that our attention, and so maybe this stuff happens,
Yeah.
and it's just that we're focused on it now, right? And that kind of thing.
I
I'm
do
not
remember
sure.
during COVID, there was all those like the food processing plants, right? Like the
Yeah, I
chicken
remember that.
factories,
Yeah.
all those, like they were on fire everywhere across the
I remember
country, and they were saying
that.
in a
Yeah.
matter of weeks there's going to
Yeah.
be food shortages because of this. But then nothing really seemed to materialize because of that. There was higher inflation not too long after, but at the same time there wasn't mass empty grocery stores because of it. So, yeah, maybe we are just hyper fixated on it. Maybe that's the explanation for it. But I don't know, man. Oil is just so important, and if it's everywhere, it's hard to see it going without being some major repercussions.
Yeah, it's the backbone to everything, especially in a just-in-time economy that's
Yeah.
globally interconnected. And yeah, it's going to be bad. Look, like I've been saying it since the war. If there is not enough energy for the economic activity, over a long run, right? Like a year, 2 years, will we find alternatives? Will we adapt? All of that, yes, 100%. The long run elasticity is much better than the short run. But, in the short run, like we are looking at a global depression. It's not a question of do we go into a recession, like yes or no. It's a question of is it a global recession or a global depression? That's really the ultimate question now is like, if this goes on another 6 to 9 months, 12 months, like no one really knows what the exact point in time is. But if this goes on, if this continues, especially if it escalates, there's no other word for it than a global depression. And, it's really difficult to, it's one thing to print money, right? When you have a demand issue and you have a demand hole or a demand shock. It's one thing because you just print money. The central bank can print $20 trillion today, right now, in the snap of a finger if they
Yeah.
wanted to, and they could airdrop it to everyone, and boom, you got demand. That's easy. Western economies are very good at that, right? With QE and all the. It's a whole other thing when it's the physical world that is acting as a constraint because you cannot print helium. You cannot print oil. You cannot print natural gas. You cannot print aluminum. All of these are affected, by this, because oil is not only, what you put in your car engine, but is the backbone of diesel, jet fuel, gasoline, and then plastics. And like you start going down that list and, yeah, it's there's no other word to describe it than a global depression. If this goes on for another half a year, 6 months, 9 months, something like that, probably somewhere in that range, you're talking a global depression. Now, are different countries going to feel it in different ways? Yeah. You could have food shortages and millions of people will die if it goes on for another year, with urea and what's going on there with fertilizers. And if you can't get energy to run the tractor or to run the truck to get the food from the farm to, like, people are not realizing just how bad this potentially could be.
So have you gone on a Costco run? I don't know if you have
I
Costco. And
I already have I already have quite a bit of food, water, ammo, I got PPE, PPE, masks, and I got CBRN gas mask with like filters. I got power generation. I got like a little solar thing. I got a radio. Actually, a couple of radios. I'm kind of into the whole radio thing. So yeah, I'm pretty good. I try to always keep like a year's worth of food. So
Wow.
I don't think we're gonna in the U.S. I don't think we're getting like food shortages. I don't think it'll be that bad. If we really wanted to, we could shut off the tap and redirect everything. And look, one of the areas where Biden should have taken more credit and the Democrats should have taken a lot more credit, in my opinion, is during their term, we started to export more oil than we consumed. It might have actually first happened under Trump, but I want to say it happened under Biden. I know for sure that our exports reached a record under Biden, and they didn't want to talk about that, obviously. But we have done very well in becoming energy independent. So if we really wanted to, we could kind of shut in, circle the wagons, and things would be okay for us. I don't think we would have food shortages or anything like that. So yeah, but Southeast Asia, not so lucky. I think that they could be
Speaking of U.S. being king when it comes to oil, fresh new high for oil exports. Total U.S. exports have surged 2.5 million barrels per day since the Iran war began. U.S. oil product exports alone surged to 8.1 million barrels per day, the highest on record. Crude oil and petroleum products exports have doubled since January 2022. And of course, that is the Biden times. But it doesn't give us the goods we need, right? I mean, we might have the energy, do we get fertilizer, right? I mean, like the different things we need for the food. It's a lot of components.
And you start looking at like rare earth minerals. We're dependent on China for 95 to 99% of rare earth minerals. If everyone is kind of circling the wagons and looking out for their own national interest, what do you think they're going to do with rare earths?
Yeah.
What do you think semiconductors? I mean, this is crazy, but like 85% of antibiotics come from China. I actually have a little list here that I've been keeping because it is just so crazy. So active pharmaceutical ingredients, 55% of the actual drug that goes into the medicine you take, 55% come from China. 95% antibiotics, the API for antibiotics. Vitamins, 85%, 88%, excuse me. Semiconductors, 90% import reliance. Solar, lithium, rare earth minerals, graphite, antimony, gallium, all these various different rare, like we are not in great shape in that way. Like I don't think that there's probably a bigger critic of globalization, especially the way the U.S. handled it, than me. So I don't want to like beat a dead horse, but we really, our so-called leaders really screwed us, over recent past.
Do you buy into the decoupling thesis that this whole entire mission is to split the world in two and have our friends in our circle and China can have their friends in theirs?
To some degree, yeah. I do think that we reached peak globalization. If you look at kind of more secular trends as a pendulum that takes, call it 50 years to go from one side to the other. We started globalization in the early 80s, call it, and I think we reached peak globalization. And that pendulum kind of lost momentum, and now it's starting to swing in the other direction. China is, just as we have realized here in America, whoa, we can't rely on China for 90% of XYZ that is critical that we need to survive. Maybe that's not so good. Maybe we should be able to make some of that. That mindset has kind of started to, Trump, MAGA, right? Trade deficit, tariffs, all that. Okay, that's good. But there's a critical missing piece, which is China, right? China actually, and not very many people talk about this, but I've done quite a bit of research on on their I'm very interested in the CCP and the way they talk about economics, the way they talk about their economy, the way that they talk about their economic goals. They've been wanting to reorient their economy, just as we're trying to reorient away from a debt-fueled overconsumption, heavy import reliance, huge trade deficit, Triffin's dilemma, all that, hyper financialization, extreme wealth inequality. Just as we're trying to be like, oh, maybe we should have a real economy, and actually make real things and not just sell, financial services. Just as that pendulum is swinging here in America, in China, they have realized they have gone too far with their subsidized kind of overcapacity and all that. So going back the past 5, 6, 7 years, there have been public comments, and now with AI, people can search this. There have been public comments where they have, look, like we got to try to reorient our economy much more ironically towards something that looks like America. Domestic consumption has been their goal. Now, it's been very difficult for them to stimulate domestic consumption, but they are trying. They are actively trying. And I try to keep up with try to stay awake for the China show on Bloomberg every day. I'm that much of a nerd, right? Because you get the China analysts that live in China. And just like we have our people that follow the Fed, every little word, and they're an expert, you got that with China too. And so I always try to like make a point to, but they have been trying to restructure their economy towards domestic consumption, just as we have not been very successful in reindustrialization and that kind of thing. They have not been very successful in turning their economy around into something that looks more like ours. So, this is something that's going to take a long time to play out.
Yeah, and they've got their own issues, right? Heading towards a demographic cliff. Their population is projected to be cut in half by the end of this century, and they're going heavy into robots, right? You see their robots compared to ours. They're pretty impressive. These things are doing kung fu backflips, and it's not too far a mental leap to see them going from backflips to working on a factory line. But yeah, I mean, you have in hotels, you have robots delivering room service, and it's really much more common in China than it is here right now. But yeah, they're not having any luck, and they're facing deflation, right? China is in the middle of a sort of deflationary crisis, while the rest of the world is looking at inflation as the big boogeyman.
Yeah, here is China PPI. Put a line here at 0. And they've been their PPI, their producer price index measure of inflation, just went positive. So yeah, it's I think it's that global reordering, that I've been kind of talking about for years now. I really think that is kind of the big trend here. And to loop in Bitcoin to it, I think that's going to be immensely beneficial. Because again, going back to what I was mentioning about taking a long time to reindustrialize, it's also going to take like 10 to 20 trillion dollars to reindustrialize. There's so much printing that's going to happen. And, if you're moving away from a centralized world, a fiat, kind of the post-Bretton Woods sort of order, what are you moving towards? People misunderstand a lot of the more like traditional finance people. They're like, well, what could replace the dollar? And it's like, nothing is going to replace the dollar. That's not the point. The point is we are moving away from centralized instruments like the dollar, like the yuan. Now, is the yuan share of FX reserves going to grow? Absolutely, and it already is. So there is definitely that trend already is intact, which is dollar share is declining and yuan share is rising, but the yuan is not going to become 75% of global FX reserves. Right? There is no replacement for the dollar. The point is that we are moving away from that kind of thing. And right now it's gold, and central banks have been buying gold, and that's been a huge beneficiary, right? And I caught it as buying gold in like 22 when everyone hated it. Everyone was bored with it. Oh, this thing's not doing anything, right? That's when you always want to be buying. And so, gold had its run. I don't think it's over, but I think that Bitcoin is going to have enjoy much more of that strength, or much more of that theme, the benefit from that theme of diversification away from the dollar, because you look at what's going on in the Middle East, it does everything that gold does better. Talk about a tanker ship, right? And you got to pay a toll to Iran. Number one, Bitcoiners always said Bitcoin is money for your enemies. So, we're kind of seeing that play out in real time. But say you're a tanker ship and you got to pay a toll. Like, what are you going to do? Like, carry like a bunch of gold bullion? I mean, we're talking $1 million dollars worth of toll. Some of these tankers carry a huge amount of oil, and we're talking like $1, $2, $3 million worth of gold. That's a lot of gold. It's heavy. You got to secure it. You got to verify it. What if the tanker gives the IRGC fake gold, right? So the IRG, and what do? Send a speedboat over it? Like, you know what I mean? You start thinking about it, it makes no sense. But you can digitally transfer Bitcoin, and it's verified in 10 minutes, 15 minutes, 20 minutes, depending on your fee. And it's globally recognized. I think it's just going to take time. I think people are impatient. I think that like this trend is there and it'll play out. There will be volatility within it, but I think Bitcoin is going to start to enjoy some of the benefit from this kind of general shift away from peak globalization, which I think 2020 was probably the peak. And history books will probably point to 2020. We've reached peak globalization. We're moving towards a world of much more regionalization. I think that the Greenland, Canada, Venezuela, Cuba thing, if you look at what all those countries have in common, except Cuba, it's natural resource, right? And that is one of the things that we lack. We run a $1 trillion per year current account deficit. Russia, we're trying to be more like Russia in this new world, and by that I mean not the bad parts, but actually having real resource and actually maybe running a trade surplus, or at least balanced trade, being able to produce critical components, minerals, commodities that everyone needs. And Greenland, very commodity rich. Venezuela, obviously very commodity rich. That is what all those have in common. And I think that there's more to that story than people are realizing, which is that if you are the U.S. and you're Scott Bessent, you were at one of the most legendary macro funds in the world that took down central banks of developed economies like the Bank of England, you would look at the dollar's share of FX reserves going like this and gold share going like that, and you would be like, oh boy, if we do not do something in the next decade, we are going to have a much, much, much weaker dollar. We could get a rapid kind of unwind. We need to start accumulating countries, a kind of regional block like the ECB maybe, to soften the balance of payments below that would come. Because as you move towards gold and eventually I think Bitcoin, what that means is that countries' currencies are going to start to become valued much more on fundamentals, on basic kind of balance of payments. And the dollar at 99 or whatever, what's it at today, 98, that is mispriced. That's severely mispriced given our $1 trillion per year current account deficit, $1.7 trillion per year fiscal deficit. The dollar on a purchasing power parity basis is even more overvalued than it was in 1985 going into the Plaza Accord, where the DXY dollar index was at its peak 164. We are more overvalued here than we were back there on a fundamental basis. And so, as the world moves to gold, that means there's less demand for dollars, right? There's less of that recycling into dollars, which has helped get it so overvalued. And you start removing that demand, whether it be the petrodollar that we're kind of starting to see on shaky ground with the Middle East, or China de-dollarizing, diversifying away from all of this. It's not going to cause the dollar to be to go to toilet paper overnight, but over a decade, over 2 decades, it will cause the dollar to weaken. And sure enough, what have we seen from dollar yuan? Is again not talked about nearly enough, but going back to Liberation Day, the dollar has been weakening in a straight line versus the yuan. And not only that, but China manages their currency. So what this means is they are allowing it to strengthen versus the dollar. And it was the only currency I found, major currency, right? I think the Brazilian real might have been flat, and there were a couple kind of minor ones, but major currency, the only major currency to strengthen versus the dollar from the start of the war to kind of the quote unquote end of it. It was one of the only major economies currencies to strengthen versus the dollar. And again, that doesn't happen unless China allows it. If you're trying to shift your economy away from an export driven model, a subsidized export driven model, towards much more domestic consumption and something that looks kind of like what we have, you want a stronger currency, and that'll help. And they've talked about internationalizing the yuan. We see tolls being paid in yuan. So there is like a very large theme there. But suffice to say, I think that gold got a huge benefit from this theme. I think it will continue to. But right now it's taking a breather, and Bitcoin held up extremely well throughout the war. Now, granted, it was pretty beaten down here, but it held up very, very well. It outperformed gold by like 20% through the war. It outperformed the S&P 500 by like 18%. It outperformed treasury bonds, right? It outperformed everything. And so, yeah, did we rip higher in price to 100K? No, but we outperformed traditional safe haven assets like gold, like U.S. treasuries, like the S&P 500, arguably the best savings account in the world. So I think that shouldn't be missed.
Yeah, I mean, if you look back at the early February, we were just falling like a knife through butter, right? And we were able to catch our footing. And if you had told us back then that we would be experiencing a global conflict / war from the end of February on, you would not guess that Bitcoin is at $77,000 right now.
Even the Bitcoin bears are surprised with Bitcoin strength.
All right. Well, Infra, that takes us to the end of our hour. Another tour de force, a very active day in the markets and the globe, of course. Thank you so much for your time. Everybody go check out Infra's YouTube channel, Infranomics, blowing up over there. Check out our YouTube channel, Daily Stack HQ. We'll be back tomorrow with the Friday Stack. Thank you so much for checking in every single day, 12:30 Eastern. We are live. Until next time, everybody. It's been real. Catch you soon.
See you guys.